If you're looking for advice on how to manage your money better, you've come to the right place. Over the next hour, we'll give you actionable insight that you can use to make the right financial decisions. First, we'll look beyond the regular parameters that you could look at when you're choosing a mutual fund scheme to invest in. There are ratios that help you understand the risk inherent in a mutual fund scheme and the relative performance of that scheme compared with its peers and, of course, the benchmark. Now, we'll help you understand all of these so that you can ask the right questions. Then we'll discuss ULIPs. They were a popular product for a while, particularly because of the advantage that they offered on the tax front compared with equity mutual fund schemes. And the question right now is, should you continue to put money in them today? We'll also talk about the implications of the RBI rate hike on your EMIs and the expectations from tomorrow's monetary policy review. But first, let's start with the headlines. Benchmark indices extend losses for a third straight day as investors keep track of soaring inflation and aggressive rate hikes by the central bank. The Nifty slides below 16,450 while the Sensex sheds over 500 points. Rate-sensitive stocks drag the headline. The Monetary Policy Committee is expected to raise repo rates once again just after a month after the off-cycle rate hike as the central bank goes in firefighting mode to fight inflation. After the Defence Acquisition Council approves proposals worth over 76,000 crore rupees for the armed forces, defence stocks have a field day in trade. The ministry believes that this will be a big boost for the Make in India campaign. RBI releases new provisioning guidelines for NBFCs, specifies rates of provisions for outstanding loans extended by the NBFC upper layer. Street believes that it will not affect most players except LIC Housing, which would have to provide extra, and that could slightly hit profitability. In a major boost for power equipment makers, the government allows private companies to tie up with states to set up manufacturing zones. This is another Atmanirbhar push by the government as it relaxes some bidding norms and says that states should have a minimum of 26% stake in the venture with private companies. India reports 3,714 new COVID-19 cases as they surge for a 15th consecutive day. All India test daily positivity rate stands at 1.21%. Bengaluru and Mumbai bring back mask mandate. All right, let's kickstart the first conversation of the day. And investing is as simple or complicated as you'd like it to be. And there are certain aspects of complexity that actually help you make better decisions. And we're not here to tell you that you need to understand every single ratio and you need to look at it yourself. But it happens that when you go out and meet an advisor, for example, and that advisor is giving you an option of 3 or 4 mutual funds to invest in, then you can look at some of these ratios and you can ask what could be the right questions. Santosh Navlani, the Chief Operating Officer of ET Money, is joining in. Thanks so much, Santosh, as always, for taking the time. Let's talk about the setting first, or the context first, which is that generally when investors look at choosing a mutual fund scheme, they look at the past performance of the scheme. And we've spoken at length about the requirement to look at, for example, at least rolling returns. But you can be a little more nuanced when you look at the various parameters, can you not?
Hey, Alex. Yeah, hi. As you rightly said, Alex, it can be, investing can be as simple or as complex as we would like to be. So while on the face of it, things can be very, very simple and straightforward. If you are willing to invest for the long term and make your life simpler by sticking to right fund categories and not bother about a lot of other categories which are not really useful from a standpoint of being part of your portfolio. But if you really want to be always be in the right boat at every point of time, always be actually rising with the markets or avoiding downside at each point of time, then it helps to make it a little more complex and look a lot of things underneath, which can help you take right investment decisions. So we can go one by one. As you rightly said, we don't need to look at all the several indicators or ratios which are available to the investor disposal, but looking at a few can actually help you take right decisions.
So let's get into it then. And before we start, I know that some of these might literally be Greek, but we promise to make it as simple as possible, right, Santosh? So let's start with the Greek alphabet beta. How does it relate to mutual fund schemes, and why is it so important to look at?
Yeah, so beta basically indicates, in simplistic terms, Alex, the excess return or excess risk that the fund is taking, compared to the benchmark. So typically, this is expressed as a value which typically ranges from 1 point something to and it can be lower 0 point something, wherein one means that your risk in the fund is almost equal to the risk in the benchmark. To understand it better, let's look at, for example, a large cap fund and compared to Nifty. So if you look at a large cap fund where the beta of the fund is say 1.1, it actually indicates that if the fund falls by 1 percentage points, if the benchmark falls by 1 percentage point, then the fund will fall by 1.1%. If it is 0.9 beta value, so then that means if the benchmark falls by 1%, fund will only fall by 0.9%. So basically, if the beta of the fund is higher than 1, that means fund is more risky than the benchmark that it is tracking. And if it's less than 1, that means it's less risky than the benchmark it's tracking. So it always helps to stick to a lower value, like 1 to 1.05, 1.1, or go up to 0.9 on the lower side. If you actually go towards funds whose beta is say 1.2 or 1.3, then you basically are inviting a lot more risk in your portfolio compared to the underlying benchmark that the fund is tracking. And similarly, if you go way too low, like 0.7 or 0.8 beta value, that means you will probably be leaving some kind of returns on the table just to protect downside for your portfolio. So sticking to a tighter range of funds is far better than actually avoiding the risk altogether. But it's important to know that what's the beta of your fund, and not invest in dark just by looking at past returns of the fund in that sense.
Okay, so that's the first one that we're talking about today. There's also an R squared, and I understand that R squared relates to particularly actively managed funds, right? And it tells you how actively managed it is. How would you explain it?
So to put it simply, Alex, R squared actually is an indicator for you as an investor whether the fund actually is trying to generate returns from the constituents that the benchmark has in its fold. So, for example, if the R square value is represented on a scale of 0 to 100. So the closer to 100 you are, your fund is, that means your fund is similar to benchmark in terms of underlying risk, underlying constituents, and things like that. If it is away from 100, or like say 30, 40, that means the fund is actually not at all similar to the benchmark it is tracking. So it is hard to really have that kind of scenario in Indian context, simply because SEBI's rules are very, very tight in terms of what a fund is supposed to do if it is a part of a category. So, for example, if a sub fund is a mid-cap fund, then the benchmark for that typically happens to be mid-cap 150 TRI index. And SEBI is very clear that what a mid-cap fund means. So the fund manager may not really have enough room to really play outside of that thing, which is good for the investor. That means they're actually going to get what they are supposed to get, or what they expected to get. So long story short, it basically means the closer to 100 your fund's R squared value is, that means you are not going to get surprised by discovering that fund actually turned out to be something else compared to what you intended to be. One caveat I would try to put it is today a lot of mid cap funds actually don't operate fully as mid cap funds, simply because SEBI's definition says that a mid cap fund is a fund which actually invests at least 65% of the corpus in mid cap stocks. And 35% is left to imagination or risk management philosophy of the fund manager. So today, a mid cap fund may not actually show a R squared value which is desirable, which is towards 100, simply because a mid cap fund may be not investing like a mid cap. It has a large part of the portion, maybe one third at times, maybe 30% at times, into large cap stock, which will mean that the R squared value of a mid cap fund doing such kind of things will actually be lower than 100 and maybe towards 70 or 80, which means it is deviating from the benchmark that it is supposed to track. So which is not a good scenario for an investor to be in, because when you, as an investor, when you construct a portfolio, you are looking at what role a fund is going to play in your portfolio. And when the fund manager actually deviates from the mandate, that means it is not going to do the objective or achieve the objective that you intended to be. So always prefer a fund whose R squared value is towards 100 instead of actually picking a fund which is away from it.
Okay, but a small caveat there with the example, for example, and we spoke about quant mutual funds, and I think a lot has been talked about. We don't understand what their secret sauce is, but they have seen quite a bit of churn in their portfolios. They have a relatively low R square number, which indicates that they're not very close to the benchmark. Is it always a bad thing?
Not necessarily, Alex. As I mentioned, the fund manager is basically controlling also risk in the portfolio. So a mid-cap fund manager, when you're investing in a mid-cap fund, is bound by SEBI's definition, or trying to interpret the SEBI's definition that I need to only invest up to 65 to qualify as a mid-cap fund. And let me do that and cut down the risk in the portfolio by having remaining corpus of the fund in large cap. So when a fund manager will do that, that means that mid cap funds R squared ratio will typically show towards lower end of the 100 and not towards 100. So if it is being done, so one way to look at it is, if the fund is demonstrating really strong downside protection and the R square value for that is lesser, then it is a good fund in that sense, because it is controlling risk, and only to control risk it is deviating away from the benchmark and hence able to protect downside for you. But I also need to look at, as an investor, on one aspect where I chose the fund because I wanted to take an exposure of mid cap to that extent in my portfolio. And when the fund manager actually deviates from it, that means my portfolio objectives as an investor may not get achieved, because fund manager chose to cut down the mid cap exposure and went towards large cap or whatever securities it went into. When the market turns, and the fund may underperform. Hence, as an investor, you should always be prioritizing to invest in funds whose R square value is towards 100, simply because that guarantees you that it is going to invest like a benchmark, it is tracking, and hence you are far more at peace that you will achieve investment objectives the way you have planned, instead of letting the fund manager do that too much risk management in the portfolio, simply because it intends to cut down the downside of a large corpus that is managing.
Let's talk about alpha. I think this is a concept that a lot of people can relate to and are familiar with. So how would you explain it?
So alpha is just the excess returns. It's actually a measure of returns, I would say, not necessarily risk. But looking at alpha always helps you whether the fund is outperforming the benchmark or not. So whenever the value and alpha is expressed as excess returns over the benchmark. So if your fund's alpha is 1, that means it has outperformed the benchmark by 1%. If the value is 2, that means that the fund has outperformed the benchmark by 2 percentage points over the period of comparison, which typically is about 3 years and 5 years. If it is -1, that means your fund has underperformed the benchmark. So looking at alpha gives you an understanding of excess returns the benchmark is fund is generating. Looking at beta gives you an understanding if it is taking more risk than the benchmark has underneath it. and R squared gives you an indication that whether the risk and alpha are being generated by actually following what the benchmark is supposed to do, compared to having some kind of other extra risk management principles, or for that matter, maybe too much churn, which the fund is probably doing.
Fair point. And in fact, I think this also points out that you have to look at these ratios not in isolation but in combination. And if one is a very sharp in excess of its peers, then perhaps one of the other ratios will explain why that is. Let's talk about standard deviation as well. Of course, we've studied this to a certain extent in school, whoever remembers it, but how does it relate to mutual funds?
So I think it's one of the most misunderstood stuff, Alex. Typically we look at standard deviation as actually it is defined as a risk parameter, and it is rightly so. It is a risk parameter, but more than risk, which people end up confusing as risk means downside. No, risk is not downside. Risk is uncertainty that your expectations or your strategy may suffer from to achieve the objective. So the right kind of way to define risk with respect to standard deviation is volatility. So a standard deviation is measurement of how volatile the returns are of the fund. So typically, when as retail investors, we look at the past performance of the funds. We look at last 1 year, 3 year, 5 year return, and say that it is looking really good. Let me invest. And ultimately, what happens is we suffer from downsides, some kind of ups and downs in the portfolio, and only realize that no, it is not a straight journey. It can be a lot of ups and downs in the marketplace. So when your fund is showing a return of say 15% or 20 percentage points. Now 15 or 20 percentage points over sustained periods of time, like a 3 or 5 year period, is not a small number. It's pretty healthy return. And it makes sense to look at standard deviation for those funds specifically, because it will tell you what kind of range the fund would have generated if you had stayed invested for that 3 year period. So for example, if your returns for last 3 years is 20%, but standard deviation of that fund over 3 year period is about 15%, that means your return at any point of time could have been as high as 35%, or it can be as low as 5% as well. 15% is basically your standard deviation, 20 is return. So you add 15% to your 20, which is your return, and that makes 35. And then to understand the lower range of returns, which is possible, subtract the 15% from 20, that's 5. So your returns at any point of time could have been as low as 5%, can be as high as 35%. Now, it may sound still good because you're still making 5 percentage points as positive return. But now imagine that you turn the table and say, make it that your returns were 15%, but standard deviation was 20%. That means your returns on the higher side would have been still 35%, but the lower side could have been minus 5% over this 3 year period. So that gives an indication that your standard deviation, if it's higher than the returns that you are seeing on the chart, on the table, should give you an indication that you actually have higher risk in the fund than the return which is being shown here. So ideally, you should stay away from assets which actually have very high underlying risk, that is standard deviation or ups and downs or volatility, what you want to call it, then the returns that is potentially generate. And equity as an asset class typically always has larger standard deviation than the return it can generate over long periods of time. And hence, being invested at all points of time, 100% in equities may not be judicious decision. You cannot run away from the volatility, but what you can do is actually add some amount of cushion of debt or gold or the other asset class in your portfolio, and say that how as a portfolio my standard deviation can be lesser than the full equity portfolio. And when that happens, your investing experience will be far, far better. You'll probably be able to buy time into the market by staying invested, because your returns will be more stable. So ultimately, the point of the matter is look for assets which have lower standard deviation compared to higher standard deviation.
Okay, let's quickly run through Sharpe ratio as well. Unfortunately, Santosh, these are difficult concepts to explain, but we have to run through this quickly. What is the Sharpe ratio? How is it important?
So, Sharpe ratio basically in plain terms means risk-adjusted return. So, when I'm looking at returns as an investor, say 20% again, for example, one should look at what is the risk-adjusted return in a way that how much risk the fund manager has taken to generate that return. So, typically, it is generated calculated as returns over risk-free return, risk-free return that I would have generated as an investor. So, for example, if your return is 20% as a fund and risk-free return in the marketplace, which typically is GSEC yield, government securities in that sense, which is currently about 7.5% in the marketplace today. So risk-free return is 7.5. The fund got 20%. That means excess return is about 12.5 percentage points. Very, very healthy. But what is the risk? That means standard deviation that the fund saw over this period to generate that excess 12.5. Now, if the standard deviation is higher for this excess return compared to the return itself, that means the excess returns per unit of risk. Every time as a fund manager, I took risk, I actually delivered lesser return or higher return determines how good or bad the fund performance is. So if you are, for example, Sharpe ratio shown as 0.3 percentage points for a fund, that means for every unit of risk that I took as a fund manager, I generated 0.3% excess return for that risk, which is healthy. So as long as your Sharpe ratio value is positive, that means the fund is actually generating some kind of excess returns for the risk it is taking. But don't look at Sharpe ratio in isolation. Compare the Sharpe ratio of all the funds in the category that you're evaluating. And then in that category, you should be picking up Sharpe ratio, which actually a fund with a Sharpe ratio, which is possibly better than the other ones after looking at alpha, beta, R squared, and standard deviation. So look at all these five things in together, and you'll be able to make a better decision for your equity investments.
I would also like to point out that since these are slightly complicated concepts, do write to us any questions that you might have, and Santosh, I'm sure, will be very happy to talk about these at length again, I'm sure, because we'll be speaking to him very soon. Santosh, thank you so much for taking the time. Always a pleasure speaking with you.
Thanks, Alex.